Good afternoon, everyone, and welcome to Boucher Finance Group's year-end tax planning and what to expect in 2023. My name is Martin Shields. I'm the Chief Wealth Advisor here at Boucher Finance Group, and it's great to be here with you on this somewhat rainy afternoon. I hope that everyone had a great Thanksgiving and Thanksgiving weekend. And buckle up, folks. Tomorrow is December 1st. Can you believe that? We're going to be in the holidays before you know it and into 2023. It's great to be here to kind of give you some guidance on their taxes and what you can do from a planning perspective. We always tell our clients, in life, there are many things you cannot control. And in particular, from a finance perspective, you can't control the direction of the markets, and you can't control what the IRS is going to do with its rules and regulation. So don't worry or stress over those things because you can't control them. But you can control other things. For example, on your investment portfolio, you can control how you're allocated for your personal situation. And from a tax perspective, you can do some tax planning. So focus on the things you can control, and the things you can't control, don't worry about them. So with me today are two of my colleagues, our tax experts. One is Nicole Goebel. She's a CPA and one of our wealth advisors. So it's great to have her here, as well as Vincenzo Testa. He's also a CPA. And he is also going to be a CFP, just passed his CFP exam. Can't use the designations yet, but will shortly be a CFP. And he's one of our associate wealth advisors. So it's great to have them here today. We've got 5 topics. Oh, there's the picture of all of us, just so you remember what we look like. We've got 5 topics we want to go through today. Vinny will kick it off, talking about gifting strategies and maximizing retired contributions. I'll go through some investment strategies with you. And Nicole will wrap everything up, talking about the Inflation Reduction Act of 2022 and the Secure Act of 2.0 inherited IRA rules. So we know you only have a half an hour, so we'll be timely. So we'll kick it off here with Vinny talking about gifting strategies.
Thanks, Marty. So for those of you that want to gift, give gifts to people maybe around for Christmas time or just any other ordinary gift that you give towards the end of the year for someone close to you, there's some opportunities and strategies that you could use to potentially alleviate your tax situation and be compliant with United States tax code. So, one of the things you could do is, donating appreciated stock in terms of a charitable contribution. So, in this regard, you get to deduct the full market value of the stock and you never have to pay the capital gains tax. And, this is adverse from, potentially selling the stock, paying capital gains tax, and then donating the cash. We could take one step out in that situation and just donate the full value of the stock and receive the full deduction on your tax return and remove, the capital gains tax. And it's really also a great tool to diversify out of a concentrated stock position. You don't want to have all your eggs in one basket, and you don't want your stock portfolio to be, heavily weighted towards one sector or industry or one company for that matter. So this is a really great opportunity to diversify your portfolio as well. Another great option for gifting is a donor advised fund. So basically, this is an account that you could front load potential charitable contributions into. Let's say you make $10,000 per year in charitable contributions, but you don't itemize, right? So this gives you the opportunity to potentially, let's say, front load 3 years worth of charitable contributions into 1 year. So putting 30,000 rather than that 10,000 per year, and you get to itemize in that particular year and receiving that tax benefit that you would not have received if you had not opened the donor advised fund and front loaded those contributions. Another charitable contribution strategy to alleviate some tax liability and help out your tax situation is qualified charitable distributions. So if you're charitably inclined, QCD is a really great strategy to consider. So basically, this is taking your IRA distribution, and it can be a required minimum distribution or just a IRA distribution because you're able to do this at 70 and a half or above, age 70 and a half and up or above. And your RMDs kick in at 72. So they really increased the RMD age when they made the change in the RMD age, but did not increase the qualified charitable distribution age. So you could donate up to $100,000 per year, from your IRA at over age 70 and a half. These are available from various types of IRAs. So basically you would, again, you would just take a distribution from your IRA and then, make a charitable contribution directly out of your IRA, and it would come directly off of your taxable income. Great tool if you're charitably inclined in that regard. If you have no use for your RMD, but you're being forced to take it because of the IRS, really a great strategy to implement and alleviate your tax situation. The thing about QCDs is that the funds must go to a 501c3 charity. So that's one of the requirements for this to work out the way it's supposed to. And then you must manually adjust the amount reported on the form 1099-R on your personal tax return. So the 1099-R you'll get from the brokerage house that holds your IRA in which you perform the QCD. So how does it benefit me? So the amount donated is excluded from federal taxable income in some states, including New York. You receive a tax benefit even if you're not itemizing, similar to the donor advised fund I was just talking about. So if you don't itemize your deductions, you take the standard deduction, doing a QCD would give you that tax benefit, even though you're not itemizing and taking those charitable contributions year in and year out. It reduces your adjusted gross income, and this really comes into play for multiple things, right? So you could potentially put you under the threshold for the taxable amount of your Social Security. Potentially, you can go from 85% of your Social Security income being taxed to 50%, things of that nature. And then there's also Medicare premiums, right? This could affect your Medicare premium. So IRMAA is really the amount that your Medicare premiums are calculated out off of. So your adjusted gross income in the 2 years prior really determines how much you're paying in Medicare premiums. And by taking a QCD, this reduces your adjusted gross income and could potentially lower your Medicare premiums. And then again, another great way to decrease your tax liability is potentially putting you under the threshold for net investment income tax. So if you're over a certain income threshold, you have to pay a 3.8% tax on any investment income that you have. So reducing your adjusted gross income with a QCD could remove that tax as well. And then just very quickly, you could gift up to $16,000 in 2022 and $17,000 in 2023 to an individual. So we were talking about charitable contributions before, but this is just in regard to certain individuals, sons, daughters, nephews, nieces, friends, granddaughters, or what have you. So that annual exclusion for gifting is going up $1,000 in 2023 to $17,000. But if you gift above that, right, you might not have to pay gift tax, but you might have to file a gift tax return. I always say to clients that pretty much the average everyday person is never going to have to pay gift tax unless they gift over $24 million in their year, and that number is increasing year in and year out. So really just monitor this, because if you gift over that amount to any individual in any particular year, you might have a gift tax filing requirement. And avoid gifting appreciated assets to individuals. So sometimes it's a good idea, but usually it's not, because by gifting an asset to someone, an individual rather, that they inherit your cost basis, right? And they could be in a higher tax bracket than you. So, gifting them the asset, they potentially go and sell it and then create a larger tax liability that would have been there prior. Really not a great strategy to execute there. And then, upon your passing, any beneficiary or inheritor would receive a potential step up in cost basis on an asset, real estate or a brokerage account. So it's really beneficial to, let those assets pass rather than gifting them during the gifter's life. And then there's also gifting for education. So contributing to a child or grandchild's 529 college savings plan, those are considered gifts, right? So still subject to those annual exclusion amounts, $16,000 in 2022. And then if you're married, you can gift one individual $32,000. And again, those are increasing to $17,000 and $34,000 respectively in 2023. but there's a loophole with 529 plans. You can front load 5 years worth of the gifting limit in advance without having to file a gift tax return or being subject to gift tax. So that's really a great tool to get those funds in early and get them invested early in a child's life, and set them up for a beneficial education savings plan. And then, just something to add here, New York residents can receive a tax deduction for up to $5,000 per individual or $10,000 per couple for contributions to a New York State 529 plan. So there's a little bit of a tax savings there with your contributions, and those are not, those deductions are not associated with the federal tax return. Again, just New York. And then another note here is paying tuition directly to a college or university on someone's behalf is not a taxable gift. So contributing to a 529 plan is a taxable gift, but if you pay the tuition directly to the admissions office on someone's behalf, then that is not a taxable gift and is not subject to the annual exclusion limits. Next topic, I'm going to talk about maximizing retirement contributions. So just some items here to talk about regarding employer plans. These are plans for retirement that are usually funded through your payroll deductions at work. And you get that paycheck every 2 weeks, and you see that those 401k deductions in the deduction section on your pay stub. That's really what we're talking about here. So we have the the contribution maximum for 401ks, 403bs, 457s is $20,500 for the year 2022, and that's increasing pretty substantially in 2023 to $22,500. And there's a catch up for people over the age of 50, and in 2022 that's $6,500. And again, another pretty significant percentage increase that is to $7,500 in 2023. Then you have self-employed retirement plans. So those are obviously retirement plans that you can fund if you are self-employed, and you typically have until you file your tax return to fund the maximum contribution for those plans. Those plans are SEP IRAs, simple IRAs, and solo 401ks. And then there's also the defined contribution plan, the employee-employer plans, and the limit for those is $61,000 in 2022 and then $66,000 in 2023. So we're seeing some significant increases in the contribution limits for employer retirement plans in 2023. All right, then we could talk about the individual retirement accounts like traditional and Roth IRAs. So for traditional and Roth IRAs, you have until April 18th in 2023 to make a contribution for 2022. So basically the deadline of your 2022 tax return, you have to make the maximum or just a smaller contribution to those individual retirement accounts. So the maximum contribution for those accounts are a bit smaller. So in 2022, there was $6,000, and in 2023, they will be $6,500. And then for those over the age of 50, there's a $1,000 catch-up contribution in 2022. So the total contribution that can be made is $7,000. And in 2023, the total contribution that could be made is $7,500. So the thing with Roth IRAs and traditional IRAs is that there's income limits. In particular for Roths, if you're over a certain income limit, you can't contribute at all. So that's really why they give you that April 18th deadline to make the contributions for the year prior, because you have to determine what your taxable income might be for those years. And then we have health savings accounts, which are, in my opinion, are really the best outlet for retirement savings, because the money goes in tax-free, and then it comes out tax-free if you spend it on qualified medical expenses. So HSAs are really a great tool to save for medical costs while alleviating your tax bill. And they could be invested and they can grow long-term. And the contribution limits for those are $3,650 for an individual plan in 2022, and that increases to $3,850 in 2023. And then $7,300 for a family plan in 2022, which increases to $7,750 in 2023. And there's a catch up for people over the age of 55 in this regard, and that's $1,000. So really a great tool to save for medical costs with HSAs. Okay, then again, self-employed or consulting income, there's some things you could do to take advantage at year end and gather all of your expenses that could really decrease your taxable income. And there's certain things that some people don't know about. But if you know these things when you're self-employed and you hand them over to your tax preparer, you'd be surprised at how much it could decrease your tax liability. So really some things to pay attention to are home office expenses. So if you're self-employed and you work out of your house, there's deductions that could be taken for your home office expenses. And there's two methods that are simplified and there's the actual method. So just talk to your CPA and track these expenses, like real estate taxes, mortgage interest, getting your lawn mowed. All of these things can be incorporated potentially to, decrease your tax liability with your self-employment income. And then again, set up self-employed retirement accounts. These can help you save for retirement, and it also can, take deductions off of your taxable income and defer some of that tax, until later years into retirement, and alleviate that tax bill now. So I'm going to hand it off over to Marty to talk about investment strategies.
Thank you, Vinny. The first thing I want to talk about is tax loss harvesting. This is simply where you sell a position in a taxable account, not a retirement account, but in a taxable account that is the value of that asset or investment is below where you purchased it. So it's below the cost basis, and you basically harvest that loss. You sell it for a loss. Now that loss will carry forward indefinitely. It doesn't have to be used in a particular year. So it carries forward indefinitely, and you can use it to offset any future gains that you realize in that taxable account. And every year that you have that loss, you can use up to $3,000 to offset ordinary income. So any W-2 income that you have, you can use $3,000 annually. So it is this is again, something that you can control. For many people, they do have losses in their taxable accounts. You can sell these positions and realize those losses. The one thing you have to be aware of is not to violate the 30-day wash rule, which is simply that if you have ExxonMobil and you sell it, you've got to wait at least 30 days before you buy ExxonMobil back into your portfolio. Otherwise, that loss is void. Now, you can sell ExxonMobil and then buy Chevron, so a company in a similar industry, but not the exact same company, and that does not violate the 30-day wash rule. You can even sell in a particular sector, let's say QQQ in the technology sector, and capture a loss in that, and then buy VGT, a similar fund in the technology and growth area. And again, that does not violate the 30-day wash rule either. So just from a portfolio perspective, again, things you can control. One is always having a plan in place for any concentrated positions or any overweight areas in particular sectors. And having that plan in place, we work with many executives that have stock options and restricted stock. It is just a great way to make sure that it doesn't become too large a position in your overall investment assets. And we usually tell folks around 5 to 10% of your investable assets should not be in one particular position. And if you're talking about a particular sector, trying to keep it below 30% in a particular sector. Now, if you have an overweight in the tech and the energy area, whether it be individual position or in general from a broad exposure, this can be a good time to take some gains off the table on that. But if it's in other areas, this is still a good time to have a plan in place that when the market recovers, you know how and when you're going to want to sell those positions so that you reduce your overall exposure to them, but also minimize your tax liability with that. As we've done with our client portfolios that we're managing, this is still a good time if you want to kind of protect your portfolio to move in more high quality defensive names or sectors like healthcare and staples, and also more dividend paying stocks, which tend to do well in times of volatility or in any economic recession or downturn. For higher income earners, this is a good time to potentially move into or back into municipal bonds. So muni bonds are basic bonds issued by a municipality that are tax-free from a federal perspective. And if they're New York State municipality, they are tax-free for New York State income as well. And about 2 years ago or so, interest rates were so low across the board, but in particular on the muni side, that we moved all of our client allocation on muni bonds because it was just not worth it having it in there. But in the last 3 to 6 months, that is starting to change. We will be moving our high income earner allocations and taxable accounts back into muni bonds. And this is something to consider if you're in that category. For many clients that have cash that's more in the short term, we're buying T-bills for them, which is U.S. Treasury bills that have a maturity of anywhere from 3 to 6 to 9 months. They're earning anywhere from 4 to 4.5%, and really it's risk-free. So in years past, if you had cash that you need in the short term, you really just had to keep it in cash. And we always recommended, to keep it in cash if it was going to be within 2 years that you needed it. But now, with the interest rates raising to the levels they are, this is a great option for many of our clients that really, again, want to keep this money very liquid, but they want to start earning something on it, especially given the higher inflationary environment that we're in. And always, as we say, with the market down to the levels that it is, if you've got long-term funds, so something that you don't need for at least 3 to 5 years, this is not a bad time at all to be buying bonds and or stocks. It really is a good entry point for that. So we really have you consider that if you've got cash that you don't need more from a long-term perspective. And one of the things that, again, something you can control in this time of volatility are Roth conversions. So I'm going to focus on Roth conversions of IRAs with pre-tax dollars. And all this is you have pre-tax dollars into a traditional IRA, you convert it into a Roth, and now any growth in that Roth is tax-free. The other thing with the Roth IRA is under current tax rules, there are no required minimum distributions. So doing a Roth conversion anytime can make sense. You have to kind of look at where you are from a tax perspective and how long it will grow in a Roth. But it is particularly a good time when the market's down because, as this example shows, if you had an IRA that had a $100,000 balance, you're going to do a Roth conversion on that. You would, if the market were at its all-time highs where we were a year ago, you'd have to pay taxes on that full $100,000 if you can convert it. Now, if that IRA is down worth around $75,000 with the market being down, and you convert it, you will only pay taxes on that $75,000. And then when the market returns to its all-time highs, that growth of that $25,000, that's all tax-free. Now that's within the Roth and it's going to grow tax-free. So with the market being down, this is a great time to do a Roth conversion. A couple caveats to that. One, as I mentioned, we want to look at where do you stand with your overall tax bracket. It's less advantageous if you're in one of the highest tax brackets because you'll have to pay ordinary income tax on that conversion. The other thing, and this is very important, is you have to have the cash outside the IRA to pay for the taxes. You don't want to use the dollars in the IRA to pay for the taxes because obviously this will be a taxable event. So those are really the two caveats that we want to kind of review and make sure are going to work for you. But again, this could be a great time to do a Roth conversion depending on your circumstances. All right, now I'm going to turn it over to Nicole as she discusses the Inflation Reduction Act with you.
Thanks, Marty. So a few minor things that have passed this year that we wanted to share with you in case it affects your tax situation or someone that you know. So Medicare benefits and tax reform from the Inflation Reduction Act. So expanded Medicare benefits that include now free vaccines, caps insulin cost at $35 a month for 2023. And they've also put in place some lower out-of-pocket caps for drug costs starting in 2024 at $4,000 and all the way down to $2,000 starting in 2025. So again, this is a great thing for our clients who are already on Medicare or soon will be as they are looking to, again, reduce those out-of-pocket costs. From a tax reform standpoint, there are a few other things that have passed. So there has been enhanced IRS funding. So well, we might be able to get somebody on the phone a bit quicker from an IRS agent standpoint. They are going to have a lot more auditors. So we are sure to see some more audits. So certainly if you're self-employed, and we talked about, keeping records and making sure that you have all of the different things available to you in your records for those home office expenses, as an example, the IRS, again, could be certainly auditing a lot more tax returns that have self-employed income. That's something that we've seen in the past. But corporations are now going to have to pay a 1% surcharge on stock buybacks. And also, they've reenacted the corporate AMT. So that means that corporations are going to pay a 15% minimum tax. Again, so they're not going to be able to reduce their tax liability to zero, as could have been possible the last couple of years. Talking now about some of the energy efficient tax credits. So most of these had gone away. There were still a few for energy efficient vehicles. So the electric vehicle tax credits have increased to up to $7,500 for new vehicles, $4,000 for used. This is subject though to income requirements and some limitations. But some of the vehicles or makers that were no longer eligible, they have expanded that. So something to look into. But definitely, if you're looking to purchase an electric vehicle, make sure if you're considering a tax credit as kind of part of that purchase price, that you look at your own personal situation to make sure from an income standpoint that you would qualify for that credit. Also, installing energy efficient systems and home improvements. So I saw some of this last year with a few clients who installed, for example, equipment in their home for their electric vehicles. So while they might not have received a tax credit for the vehicle itself, they did receive a tax credit up to 30% of that cost for that installation. So windows, doors, insulation, solar energy systems, geothermal. We have had a number of clients with solar panel installations. So again, that could certainly offset the cost of that installation. And also now a small business can deduct up to $1 per square foot for making high energy efficient upgrades. Okay. Now talking a little bit about the Secure Act 2.0. So this is something that we hope will pass. There is an expectation that this bill in some way, shape, or form will pass before the end of the year. And there are some additional positives. So as Vinny talked about earlier with the retirement contributions increasing, this would also make some new changes to 401k, 403b, and other employer plans. Required automatic enrollment. And while that might not seem big for certain people, if now individuals need to go into actually, disenroll or stop contributing, that requires action on their part. So I have seen this work where even if it's an automatic 1% of income, it starts that person out saving for retirement that otherwise would have neglected to do so. Student loan repayments will now be treated as elective deferrals. And then that RMD age that Vinny talked about had been raised in the Secure Act from 70 and a half to 72. Now we see a chart on the right-hand side of the screen here where basically if this passes, anyone who turns 72 after December 31st of this year, their RMD age would increase to 73. And then in 2030, the age would increase to 74. And for those after 2033, the age would increase all the way to 75. So again, allowing us to leave money in those tax deferred accounts a bit longer. Now, we often recommend to our clients that they start spending down their pre-tax money earlier in those years that they may not yet be electing Social Security benefits, may not have other taxable income, so that over time they're taking it out at a lower overall tax bracket. But again, if someone truly does not need these funds, they can allow them to stay within those plans and not be forced to take out. And again, it gives us additional years potentially to, take those funds out in a slower progression. There's also expanded catch-up amounts of $10,000 for employer-sponsored plans for individuals aged 62 to 64. Vinny talked earlier about that amount being about $7,500 starting next year. Matching Roth contributions. So this is a big one. Even if you're electing to have 100% of your deferrals go in as Roth contributions, all of your employer contributions are always going to be pre-tax dollars. So this would allow any employer contributions to also be part of the Roth. So it would be taxable income to you when they make the contribution, but then again, it would grow tax-free within that plan, hopefully for many years. It would also allow potential Roth contributions to simple and SEP IRAs. Right now, there's really no vehicle for a self-employed individual to make Roth contributions aside from a Roth IRA. And as Vinny talked about, it is subject to income limitations. So this would really open up Roth possibilities for a lot of self-employed individuals. And I love this one, a lost and found database for retirement savings. So this is something that we certainly see. A lot of people come to us and say, I worked for this employer 20 years ago. I don't know how to access that. So I think this can help individuals. Certainly that will be able to help them to consolidate retirement accounts going forward. Okay. Okay, so the last thing I wanted to point out was some potential changes to the inherited IRA rules. So if you were following the Secure Act and have been affected by it or a family member, you know that after January 1st, 2020, if you inherited an IRA, you no longer had the ability to stretch those distributions over your lifetime or the beneficiary's lifetime. Instead, you have to fully distribute that account, whether it is a traditional or Roth IRA or another employer plan, by the 10th year after the decedent passes. So this rule has been interpreted back and forth a couple times since it passed. So in 2020, no one had to take RMDs because of the CARES Act. In 2021 and 2022, really the expectation was you didn't necessarily need to take a distribution from an inherited IRA if it was under this 10-year rule. You just simply had to take the full amount out after the 10 years. Now, new legislation is saying that, nope, that's not how we're interpreting this anymore. We're not going to necessarily go back and have any penalties for those people who did not take distributions in 2021 or 2022, but starting in 2023, if the decedent, who was the original owner of the account, was of RMD age, then the inheritor, the beneficiary, will also need to start taking RMDs. So therefore, they would need to take RMDs in years 1 to 9 and still distribute that amount fully in year 10. It's unclear whether this would apply to Roth IRAs. Under the old rules, you did have to take a distribution, a required minimum distribution from an inherited Roth IRA. But it has not been cleared up yet as to whether this would apply to Roth IRAs under this new 10-year rule. So something to be aware of, and we're certainly going to be communicating to our clients that fall into this category. So with that, I'd just like to wrap up and say thank you so much for joining us today from myself, Marty, and Vinny. We hope that you've gathered some new information from our webinar today. If you'd like to work with us on your individual tax situation and anything that you feel might apply to you that you'd like some guidance on, please feel free to call our office, 518-720-3333, and ask for myself, Vinny, Marty, or any of our other advisory team members, and we'd be happy to help. Also, remember to check out our website. This webinar will be posted within the next couple days under our Insights tab on our website, but also we have our weekly Boucher blog that we post on different topics. So we recently did one on Roth conversions, on different inflation reductions and additions that have been made. So really check that out to see if there's anything else that might apply to your situation. So thank you from the Boucher team and Steve as well. And we hope you have a wonderful holiday if we don't speak with you before.